Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to comparing financing strategies. We're going to be breaking out the assets into our temporary current assets, our permanent current assets, and our fixed assets, and using that to think about our financing strategies, having a more aggressive financing strategy and less aggressive financing strategy that we will compare and contrast. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 624 Comparing Financial Strategies tab in the Practice Problems section. Going to be closing this back up. We'll take a look at our information up top, then we'll have a smaller layout of that information that we can use to work through the practice problem. So we have up top, then we have the temporary current assets, the permanent current assets, the fixed assets. Remember, this is going to be kind of like the new thing here. The fixed assets is something we're familiar with. That would be on the financial statements. That would be the property, plants, and equipment, otherwise known as the PP&E, or the depreciable assets. The current assets, however, are the things that are going to now be broken out to the temporary current assets, permanent current assets. That's what we would have to do to estimate to help us out with this type of strategy. What does it mean to be a permanent current asset? That's going to mean that although these assets will be churning over, things like an accounts receivable or inventory will always be changing, we think there's going to be a base level that will always be basically replaced, and therefore in that sense, although it's churning, it will be permanent in that sense. So the receivables, for example, will always be replaced up to a certain level if we maintain a certain level of sales and have a steady mix between the sales that are on account as well as our collection process being somewhat steady. And then the inventory could be much the same. It could spike when we have inventory or be at a constant level when we have standard sales and standard purchasing and production plans. The temporary current assets might be as a result, for example, of a spike in sales where the inventory would be, or the accounts receivable and inventory possibly going up, and we expect them to then be going back down fairly soon after whatever temporary effect happened, and then we would see it decline again or go back down. This might be useful when considering our liabilities in terms of, do we want a more aggressive or less aggressive financing plan, because we know that the assets equal liabilities plus equity, and so we have to finance the assets with either liabilities or equity. We're going to be focusing here on financing more with the liabilities. And if we focus on financing with liabilities, then the question is, do we want to be more aggressive or less aggressive? We might be able to say, hey, I would think it would make more sense to maybe be more less aggressive or have a longer term financing, possibly with the fixed assets and the permanent current assets, and then maybe having a more aggressive plan or more short-term financing with the temporary current assets. Although, once we break it out in this format, we don't necessarily have to then adhere to that, but we can use this to kind of help us out to then think about what the appropriate amount of financing mix might be. So the total assets then add up to that $1,520,000. We got a 35 tax rate. Then we have the less aggressive financing plan, where we're going to say the asset financed with long-term sources, 65%. So notice we're just taking the total assets times 65%. Now, if you think about that, we might say, if I pull out the trusty calculator here, you might say, well, how does that line up if I had the temporary current assets at the 500,000 divided by the total 1520000, then 32% are temporary assets here, and we're doing 65% on the long term. So if I subtract -1 here, then you would think that 67% would be lining up more exactly to the ratio. So this is pretty close to lining up to what you would think would be the ratio, right? That's pretty close to lining up to saying permanent assets and fixed assets more at the long term, temporary kind of at the short term in that mix. So 65% for the long term, the other being the short term. The more aggressive financing plan, we're going to have the assets financed with long term are only 60%, so we're going to finance less with long term and therefore more with short term. The interest rate on the long term is going to be the 15%. Interest rate on the short term is going to be the 10%. Once again, the short term rate is typically going to be lower, but if we need financing going into the future, we might have a flexible rate that we have to deal with, therefore picking up more risk into the future. The long term rate typically we might be able to fix it. That might be the point of making it long term, but it might be larger or higher due to us eliminating the risk of a fluctuating rate in the future. So the earnings before interest and taxes is going to be $380,000. Here's a shorter recap of the numbers that we will be working with. Let's take a look at the less aggressive financing plan. So, and I highly recommend working these in Excel. These are perfect to kind of work with a table and just do basic formatting in Excel with percentages and the formatting of the tables. So I highly recommend doing that if you've got time to do that. You could do it in Google Sheets as well if you want to do that, free software. So interest on long-term financing, we got the total assets are going to be that $1,020,000. We said the first plan is going to be 65% is going to be using the long-term financing. So I'm just going to multiply that times the 65%. That's going to give us the amount financed with long-term financing at the 988. Then we're going to take the long-term financing, which we said was at the 15% on the financing, giving us the interest on the long-term financing, the $148,200. Then we consider the interest on the short-term financing, which would be total assets. I'm going to start all over again. I'm going to pick up the total assets here and do our calculation. We're going to say 35% is going to be for the short-term financing, simply gotten to by saying that if 65% is long-term and we're financing the entire thing, which is our assumption here, 100% minus the 65% would be the 35%. Multiplying that out, we're going to get the 532 amount financed with short-term financing, and then the short-term interest rate then being the 10%, the more aggressive rate here, the 10%, the short-term rate. That's going to give us our 53,200. So the 148,200 plus the 53,200 is going to give us a total interest of the 204,400. So then we might do some scenarios here. We might be saying, okay, well, based on this kind of breakout, maybe I'd be a little bit more aggressive here. What would happen if I just changed it a little bit and made it 65% on that would be done with the financing, with the long-term financing, and rather than what we had up top, or I'm sorry, we go to the 60% with the long-term financing rather than the 65 with the long-term financing. That means we're going to shift a little bit more towards the short-term financing. What would be the effect on the bottom line? Again, if you do this in Excel, then you could do this in a worksheet and you can actually change your data up top a lot more easily and be able to run a lot more scenarios much more quickly. So if I then say, all right, the interest on the long-term financing once again is that $1,520,000 times 60% now instead of the 65% we had last time. That's going to give us the 912. We then multiply times the 15%, the long-term financing rate. That will then give us the 136,800. Then we'll calculate the short-term financing portion. We're going to take that total amount again, the total assets. We will then be taking the percent with short-term financing. It's going to be 40%. Why? Because 60% was long-term. That means 100% minus the 60% is 40% short-term. We're going to finance the entire thing with financing of one sort or another. That's going to give us the amount financed with short-term financing, the 608. And that's going to be multiplied times the 10% because that's the short-term financing rate. Then if we were to multiply that out, the 608 times the 10%, 60,800, the 136,800 times the 60,000 or plus the 60,800 gives us total financing of the 197,600, the interest on the financing. So that interest you can compare to the prior scenario, the 2014, and you could start to run basically scenarios on the mix that you might have with more aggressive and less aggressive financing. With this type of method, and that could be easier to do or give you some more perspective to do that if you were to break out your assets between temporary current assets, permanent current assets, and fixed assets. That might give you some more perspective on where you should start, at least with regards to what your mix should be. So then if I scroll on down, we're going to do the income statement or take a look at the partial income statement. We got the earnings before interest and taxes given to us at the $380,000. That's the net income or bottom line of the income statement before considering interest and taxes. We just calculated the taxes up top. So, the interest up top. So we had the 201,400 for the first plan, the 201,400 up top. And then we had the 197,600, which is the one we just calculated for the more aggressive plan. Obviously, it being lower for the more aggressive plan if everything goes as planned. So then the earnings before the interest and taxes minus the interest expense gives us the earning before taxes. Then we would calculate the taxes on it. The taxes are going to be at the rate of the 35%. So we're simply going to be taking that 178,600 times the 0.35, that gives us the 62,510, and of course the 182,400 times the 0.35, giving us the 63,840. Then if we subtract out the earnings before taxes and then we subtract the taxes, we get the earnings after taxes. And once again, if you work this out in Excel, you could start to work these problems and put together, different scenarios with them fairly quickly, and be able to do some good projections into the future based on different kind of assumptions that can be made.